Hello and welcome to the ARC Energy Research Institute video series. I'm Peter Tertzakian, here with my co-host Jackie Forrest. Today we're going to be talking about the International Energy Agency's monthly oil market report, which was just released for the month of July. So Jackie, what are the key takeaways from this report?
Well, there's two positives and one negative takeaway.
And so let's start with the positives.
Positives are always good. All right, so the positives are, one is demand is looking really good. The first quarter of this year, demand did disappoint, and that's one of the things that weighed down prices. But the Q2 data is all in, and it's looking very strong. In fact, the IEA has now upped their outlook for demand for the year to 1.4 million barrels a day.
1.4, so that's just to give some context. I mean, I've been doing this for a long time as a view. Anything over 1 million barrels a day per year growth is pretty significant.
Yeah, it's over the 10-year average, and it just shows you that these low prices are stimulating demand. And places like India and China that were quite weak in the first quarter are coming in very strong. It looks like we're going to have good, strong growth in both of those countries.
And do you expect like the Q2 momentum to carry into Q3?
Yes, we've got the Northern Hemisphere summer driving season, and so we do expect the second half of this year is going to be almost 2 million barrels a day higher demand than the first half. So things are looking really good for demand.
So the demand side's very positive. Why don't you talk about another positive?
Okay, the other positive is, everyone in the oil markets is watching these storage levels. So after about 3 years of overproducing, we have a lot of crude oil sitting in storage tanks around the world, and that's about 300 million barrels of excess crude. Market's really keen to see that glut be pulled back, and we're starting to see the early signs of that outside of North America. So we did have a bit of a draw starting to be seen in other places in the world, and just recently, over the last couple of weeks, we've had some good draws right here in the United States with the weekly data. And so it is looking like storage might be hitting that point over the next few months where we'll start to see some meaningful draws.
So there's two sets of numbers to watch. There's the storage levels in the United States, which are indicative of what's going on in North America. And those data come out every week, so we have a real-time monitoring. The global inventories, however, only come out once a month and are lagged.
That's right.
So we don't really know what's going on in the rest of the world, safe to say, but that the trends are still positive.
That's right. The data we have right now for the rest of the world is for May. And so if this summer turns out to be, as everyone expects, a really strong time for demand, we won't really see the impact on storage levels until we get into October or so, even November, before we can really get some meaningful data to show the market that outside of the United States, the cuts are working and we're seeing storage get drawn down.
So demand is strong, and supply minus demand tells us what comes in or out of inventories. So let's talk about that negative side of the report, which relates more to the supply side, I think.
Right, so the third point was the negative one, and we're finding that OPEC is increasing their production each month and complying less and less with their cuts. And so there's two components to that. One is, the core members of OPEC had agreed to cuts, and they are slipping in terms of their compliance. So we find out this month, in July, June data, 78% compliance compared to 95% the month before.
It's somewhat not surprising. I mean, when the price goes down, the producers are less compliant because they're struggling to make revenue from lower price, so they have to crank up volume.
That's right. I mean, they're under a lot of fiscal pressure, and so now, with the price being lower, there is a lot of motivation to sort of creep up in terms of your production.
But at $45 a barrel, we'll still see 80% compliance. You feel fairly comfortable with that?
Well, that's what they're doing right now. So based on the month of June, that's what they've been doing. A lot of that was to do with Saudi Arabia. Overall, the group's up about 200,000 barrels a day over what they should be doing. The other piece to this is Nigeria and Libya. Now, they actually weren't binded by this cut agreement, and because of, there was civil unrest and other issues in the countries that caused their production to be lower, but over the last few months, like since March, together they're up about 500,000 barrels a day in their production, and that's totally taking away from the cuts that the other OPEC members are making. And so today, OPEC production levels are like 700,000 barrels a day higher than they were a few months ago.
And what's going on in the United States?
In the United States, we're still seeing production growth, but we do think with the demand growth this summer, we will start to see some inventory drawdowns in the United States too.
It's absorbing it plus more in the United States. Okay, so we've got a situation with some positive trends on the demand side. The supply side is still a bit iffy, depends upon compliance, depends upon rig counts and what's going to be drilled up in the United States and even here in Canada. What are the signposts that we need to watch as we go forward to the next monthly report and beyond?
Well, I think first of all, we need to watch this OPEC production level, and just to sort of highlight to you the impact it's having on our outlook for the oil markets. I want to show you one chart here. This is a chart that shows the supply and demand. The red and blue are the supply and demand. The delta between the lines is shown on the lines below. And the gray bars are when we're producing too much oil, and those gray bars are, for the last many years, 2 years, we've been putting crude into storage tanks. The black bars are the deficit bars. So when we actually get into a situation where we're producing less crude than we're consuming, we start to draw out of those inventories, out of the storage. And you can see the prediction, if OPEC made perfect compliance, was that over the next year and a half, we'd be drawing about 1 million barrels a day, every single day out of those storage tanks. That would basically get storage levels back to the typical level, draw down that kind of 300 million of excess in storage. Now, the next slide I'm going to put up here is what's going on today. And so because Libya and Nigeria are producing more, OPEC is slipping on their compliance, the picture is very different. You can see that those bars are about half the size as they were before. And so even at the end of 2018, we would not be drawing down all this excess. We'd still about half of the excess crude in storage in those tanks, and I think that would mean weaker prices for sure. So it's really important that OPEC starts to rein in their production levels so that we can start to see these storage tanks draw down. That's what the market's looking for.
So compliance is still really the #1 signpost.
Yes.
Followed by watching the inventories and also things like U.S. production.
Yes, U.S. production, demand, like we expect demand to be very strong in the second half. We'll be continuing to watch. That's really needed to start to draw down those storage tanks, and it is looking good so far.
Right.
And so, of course, then the storage tanks are where all those numbers kind of come together, and we'll be watching that. Unfortunately, because we talked about it, the data is quite dated, and so it probably is going to be late in the fall before we really have good data on what's going on beyond the United States.
Well, great. We'll be watching it. Please join us for our next ARC Energy Research Institute video series. Thanks for tuning in, and we look forward to tuning in on the next one.